¿Qué tal? Buenas noches, bienvenidos. Esta es la tercera serie de los conversatorios, las entrevistas, conversaciones, charlas, liderazgo para la sostenibilidad. Y esta noche tengo un invitado súper especial, un invitado que se enfoca en el tema de inversión sostenible. Esta entrevista va a ser en inglés y voy a traer a la transmisión a Tim Nash desde Toronto. Tim, very nice having you here. Welcome to the series. We have a very special person today. He's not only a very smart economist, he's very humble, I have to say. He's very modest, but he's an amazing guy. He's a crack at what he does. So thank you so much for accepting to be my guest, Tim. It's a pleasure to have you here. And let me just introduce this conversation, this series of conversations for those who are watching. So this is the goal of this conversations, these talks, is to bring guests and ideas to inspire you to bring your projects and organizations to be more sustainable. And those of you who are watching, like Tim and I, are very much interested in having a more sustainable world. So welcome, Tim. And thank you so much for being here. Let me introduce you to the audience. Tim is the founder of Good Investing, a company that supports do-it-yourself investors to align their portfolio with their values. He is the recipient also of the Responsible Investment Association's 2020 Individual Leadership Award, and he is regularly featured in publications such as CBC's The National, BNB Bloomberg, the Globe and Mail, and the Toronto Star. He is also usually seen in parks wandering around with his fiancée and his dog. So, Tim, thank you so much for being here.
Thank you so much for having me. It's an honor and a pleasure.
So, how have you been? How has an economist, Tim Nash, how did you, as an economist, get interested in topics such as climate change, sustainability, and why not continue like the typical career of an economist and going into banking, probably finance and investing, like the traditional way?
Yeah, I mean, I grew up with my dad in the investment industry. So I sort of grew up around stocks and bonds. And then I studied economics and philosophy. So I was a little bit of sort of the weird one in each of those classrooms. And, really the philosopher in me, really questioned a lot of the economic models that I was being taught. And I would describe it as almost sort of like my spidey sense was tingling. Like I knew something was wrong, but I couldn't quite put my finger on it. And then I was very lucky. I got accepted to do an exchange to New Zealand. Nice. And that's where I took a course in triple bottom line economics, this idea of people, planet, and profit. And really light bulbs started going off in my head saying, this is what was missing. Now, this was back in probably, I think, 2002, something like that. So really the first introduction that I had there. And I went back to my fourth year economics program full of questions, and they didn't have answers for me. Wow. So that's when I went to Sweden and I did my master's in sustainability, this master's in strategic leadership towards sustainability, that really just opened up my mind, taught me systems thinking and the science behind climate change and ecosystems. And I just really realized how much our economic systems were just completely missing, when it came to environmental issues and social issues. So I did my thesis looking at this topic of socially responsible investing, and this was in 2007, 2008. We looked at that time, the language we used was the financial materiality of ESG issues. Everyone, as soon as we brought up the concept of ethical or responsible or sustainable investing, people automatically assumed lower financial returns, like right off the bat. It was like, oh, that's cute. You want to save the world. Well, I'm in this to make money. But what we found is that actually companies that are leaders in sustainability often have better profitability and are ahead of the curve on a lot of these issues. And that actually a lot of these responsible investment strategies were doing just as well, if not a little bit better than traditional investment strategies. So I came back to Canada in July of 2008, sort of ready to take the investment world by storm, probably get a job in a bank and kind of climb the ladder there. And 2 months after I got home, the stock market crashed. And in the big crash of 2008, it was
just, the real estate.
It was the big one. It was huge.
Right.
And everybody panicked and the industry got frozen and there were just no jobs available and sustainability really got thrown on the back burner. That it was really like, let's fix the economy first. So there were no jobs for me. So that's when I started my first business. And it's kind of been a journey throughout, but really, over the last 2 or 3 years, this concept of sustainable investing has just taken off. And that really what's so interesting is that now with the COVID crash that we had last March, that now sustainability is on the front burner, that now everyone is talking about it. And it's such a huge part of the economic recovery this time around. Right. So, it's just been incredible to me. It was really challenging for the first decade plus of running my business. I'd get laughed out of rooms. People really didn't, understand what I was talking about at all. And then, I'm so happy that finally my patience and perseverance has paid off, that now I'm a person that's been doing this for more than a decade.
That's
and, helping people really figure out, what is sustainable investing? How does it work? How do I actually do it with my own money? And really empowering people to align their investments with their values, but do it in a smart way, not sort of being, not going overboard with it, and doing it in a way where people are still saving for their retirement and, earning returns for their future and their financial independence, but doing it in a way that's in line with their values.
That is so interesting. I have seen, and actually I had a meeting earlier today with a colleague from Germany, and she works mostly with the public sector, and was asking me whether I was noticing a difference in the private sector regarding sustainability. And I said, absolutely yes. In the last 2 years, the push towards sustainability and the interest and this topic of ESG investing has been so big in corporations, but particularly from the pandemic, since the COVID-19 happened, it's been so much on the news, but also on the phone, on the messages, on the emails, and everybody is trying so hard to get into it. But sometimes I feel, I don't know what your opinion is around this, but I feel that people don't, or organizations don't quite understand still to this day, even though things have evolved and have progressed, thankfully, companies are still not sure how to address the issue. And there is also this notion of, if it's sustainable, if it's good for the environment, it has to be not profitable, just like you were saying. So with that as a framework, I would like for you to describe in your words, what is sustainable investing?
Sure. So, and there is a lot of confusion around it.
Yes.
And it's a very muddy space. There is not clarity. And we do not have, a consensus around taxonomy and language, right? So it very much is a tricky area to be in right now. Now, the way that I approach it from an investment perspective is that, really I stick to very general financial planning rules. So when it comes to building a financial plan, we're building a pie chart, right? A portfolio is like a pie chart, and any investment plan worth its salt is going to have a mix of both stocks and bonds, right? So that's a very common principle. And, you want to have this diversification of both stocks and bonds. And then from there, I kind of split each of those up between what I call doing less evil versus doing more good. And I'm sort of being deliberate with my hand here, because most of it should be what I call doing less evil.
Right.
And this is where we get into ESG analysis. This is where we get into things like fossil fuel divestment. This is where, really the goal here is to invest in as much of the market as we feel comfortable owning, that diversification is a core value. The goal is to earn market rates of return. but getting rid of the worst companies. And this is going to be different for everyone. This is very much the philosopher in me that everyone has their own set of morals and ethics. And some people are going to want to completely get rid of entire sectors, whereas other people are going to say, you know what, I'm okay with that. I just want to get rid of the worst of the worst. I want to get rid of sort of the most evil companies there. So, you know, that ESG space, that, you know, and that sort of doing less evil approach, I would say that's getting a lot of the interest right now, especially from companies, because what's happening is we have these rating agencies. So there are two firms that are really kind of leading on this. The first is MSCI, which is a very large global multinational firm, that they are now leaders when it comes to this ESG research and analysis. The second is a firm called Sustainalytics, which was recently acquired by Morningstar.
Right.
And so Morningstar and MSCI, these are sort of like the two big firms that are now kind of doing this research. They've got teams, you know, armies that are going through these reports, assessing companies and ultimately giving them sort of an ESG score. Now, there's a lot of debate about these ESG scores and how good they are, and are they measuring the right things? And, you know, we're certainly happy to get into that. But to me, the important piece is at least they're looking at it.
Right.
Like at least we're now measuring, you know, environmental issues, social issues, and governance issues, whereas for the longest time, these things were completely ignored. So we can argue about how good the ESG scores are and how consistent they are and things like that, but at least we're now doing it.
Right.
And so that's kind of, you know, and that should be the bulk of someone's investment portfolio, is this sort of doing less evil. And I think for a lot of companies that are trying to transition, that have been around for a long time and, you know, recognizing sustainability, they're kind of going to fit into that area. But there is this other area, which I call sort of doing more good with your money, which a lot of people will call thematic investing, where we're investing in themes like renewable energy, clean tech, water infrastructure, electric cars. These are all wonderful sort of investment themes. And I just want to be really, you know, cautious that for investors that, you know, you don't want to put all of your money in these things, because they tend to be a lot more volatile and they're certainly not very diversified. So really, when it comes to an investment approach, you know, you kind of want to have a mix of this sort of doing less evil, which is kind of this ESG, or it might be, you know, divestment, or it might be shareholder engagement, where, you know, you're going to own companies, but use your voice as an investor to push that company in a more sustainable direction. Versus, you know, this other area, which can sometimes get a lot of attention. You know, it's sort of these like sexier investments in, you know, like electric cars or renewable energy, which can be good. But from an investment perspective, like that's going to be a lot riskier. It's going to be a lot more volatile. And, you know, it's going to be sort of a bigger roller coaster, where even if, you know, over the long term, it might do well. Right. But in the short term, it could fall quite dramatically, and investors need to be aware of that.
That is so interesting. And I'm very, very glad that you brought that up. And I'm actually kind of surprised that you mentioned this, like, I mean, from what I'm getting, from what you just said, is everybody has their own style of investing depending on their personal values, which makes total sense. But I would think that people coming and knocking on your door, hey, Tim, help me out. I want to do good investing with my money. I want to be responsible. They would probably steer away from fossil fuels or they would probably have an opinion, a very strong opinion, negative toward fossil fuels industries, and the more negative, environmentally speaking. But the truth is that we also have this transition to go through, right? So if oil was not available tomorrow, the economy would crash. Countries would crash. So even though we want that change, we also have to be aware of the transition.
And this is, you know, this is probably the biggest conversation that's happening right now, right? And specifically in Britain, you know, in the UK and England, they're going through an energy crisis right now. And that China, I'm seeing, is you know, shutting down production due to the lack of energy. And to me, this is kind of a fundamental problem, is this balance between supply and demand.
Right.
Now, in the short term, so what we've done is by reducing the financing, and because of the rise of ESG investing and fossil fuel divestment, that we have seen a lot of people pull their investments from fossil fuels, right? And what that means is lower supply than we would have otherwise, because there's not money for new projects and new things. And it's hard to know how much of that is divestment, how much of it is that, those energy companies really got hit hard during COVID.
Right.
So, it could have just been on their own sort of dynamics. But needless to say, have to be worried about a decrease in supply, and that demand for energy has continued to rise. And despite all of these conversations about climate change, about COP agreements, about all these things that are happening, it's not really working. Like, energy demand keeps going up. Right. And I think, to me, it speaks a little bit to sort of like the kind of like the attractiveness when it comes to a lot of these, this perception around renewable energy. And a lot of people want to invest in generation or like electric cars, where that requires a lot of electricity. Whereas in my mind, a lot of the most profitable investments are in things like energy efficiency and reducing demand. So until we can effectively reduce demand, we could run into a short-term energy crisis. However, with higher prices of natural gas and gasoline and oil, well, guess what? Now those energy efficiency investments become that much more attractive. And there's nothing like an energy crisis to get people to actually switch. I remember, there was kind of this talk we would often do about how do you get people to sort of leave the room, right? Like, if ever you're having a party and everyone's in the kitchen and you want everyone to like leave the kitchen and go to the living room, it's like, well, you can make the living room nice and comfortable and throw on some music there, but like, if you set a fire in the kitchen, everyone's going to move a lot faster. So, short term, it wouldn't surprise me if we did have an energy crisis or see prices for energy go up quite dramatically. But in my mind, from a longer term perspective, that might not be a terrible thing if it means more people are shifting in, if it means more investments in energy efficiency, which we really haven't been seeing as much as we need. But it speaks to a lot of the talking points and the psychology, and there's going to be this big debate, because as soon as you get an energy crisis, now all of a sudden, a lot of the naysayers are going to say, oh, it's the greenies' fault, it's blaming them. And so, to me, it's a really, really tricky dynamic. It also might mean that, oil stocks go up for a little bit if the oil price goes up. So this is why, like, again, I don't want anyone to like bet the farm on these new technologies or take these extreme positions. I would never want anyone to short energy stocks, which means sort of betting that the companies are going to fail. Like, don't do that. Really, to me, it's about understanding that everyone has a different idea of, what sustainability means, of what sort of ethical or responsible means to them. But for some people, like, there's no doubt that it makes sense to at least take a small step in the right direction, right? Like, even if you don't want to completely divest from fossil fuel, let's at least use that ESG analysis to invest in like the best sort of the companies that are better positioned to lead in this transition, rather than, investing in the companies that are laggards. Because they're the ones who, potentially are going to get hit really, really hard if we do see carbon taxes, if we do see reduction in demand, that, in this sort of longer term transition that is now well underway and happening faster than it ever has before, you really got to be careful. So to me, it's like, it's diversification is the name of the game. You want to make sure that you are properly diversified. And then from there, it's about understanding, how far on that sustainability spectrum do you want to go? Knowing that it doesn't necessarily mean that you'll have lower returns, that actually the most sustainable funds have had the highest performance over the last few years. But I can't promise that's going to happen. I don't have the crystal ball, and that, we could be in a situation where, there is this sort of volatility in the markets until, we're a little bit further along in that transition.
Right. Wonderful. So I had a question for you in regards to how bad a company is and how less bad of it is, and scorings and stuff. This is the negative screening that they mentioned, the scoring companies.
Sure.
This comes into play in like how they're scoring regarding their emissions or what industry they're in.
So just to clarify a little bit, negative screening, or,
Yes.
I would use the term divestment, generally refers to avoiding an entire sector. Okay. So if there's negative screening around something like tobacco, it's saying, I don't care, the degrees, doesn't matter. Tobacco, thumbs down. I don't want to invest one penny in it.
Right.
Versus, I think what you're describing is in this world of ESG, what we would do is talk about one of two things. On the one hand, you could have sort of ESG thresholds, saying that I'm not going to invest in companies with a score below a certain threshold. Right. And so that we often see this where companies need, and it's saying, okay, I'm okay with tobacco, but, we're going to get rid of the worst of the worst. The other thing is that in investing, we often have what we call an ESG tilt. So when it comes to investment funds, you're not investing in one company, you're investing in a fund that has hundreds or thousands of companies. And so not only do we get the list of companies, but every company has what's called a weighting, or a percentage within that portfolio. And so when it comes to this ESG tilt, what we're going to see is overweighting companies that have a better ESG score and underweighting companies that have a lower ESG score. So that to me is kind of more where we get into this gray area.
Okay.
Right. And where it's not about, an absolute thumbs down saying, not one penny into weapons or tobacco or fossil fuels, but you're saying, what, I'm okay with some exposure to that. But what I want to do is have more exposure, own more of the companies that are leaders and less of the companies that are laggards. Does that distinction make sense?
Yes, it does make sense. And you kind of answered already another question I had of which were the industries that you call, or that your investors call, worst of the worst.
Sure.
I suppose it's tobacco and fossil fuels.
Yeah. I mean, the history of, responsible investing it used to be ethical investing, and it was really religious. Right. And so it's getting rid of the quote unquote sin stocks. And it's sort of Christianity. It's, here in Canada, we've got Mennonites were the real leaders, but as well through Islamic finance and Sharia compliant investing. That, a lot of those very common negative screens really come from religious backgrounds. So it's weapons, tobacco, gambling, adult entertainment, pornography, things like that, right? That those were like the first things. And then now what we're seeing is, I would say the big one is climate change and fossil fuels. That, that to me is absolutely, top of mind for people right now. I would say that is the number one issue that certainly people are coming to me to be able to sort of lower the carbon footprint of their portfolio. But then, different people, I've done a vegan portfolio before.
Wow.
Where, and that's tricky because that means no makeup, and no grocery stores or like food companies, and no pharmaceuticals because they do animal testing.
Wow.
Right. So it's very, very different. Everyone, it's and what's cool is that there are options now. 10 years ago when I started this, to do a vegan portfolio, my goodness, I would have been pulling my hair out. Trying to figure that out. And now, there's actually a vegan fund that trades on the US stock exchange, where it's like the S&P 500, the, Standard & Poor's 500 largest companies. So it tracks that index, is very similar, but it's vegan. And it's actually done a little bit better than the S&P 500 since it launched, 2 or 3 years ago.
That's interesting.
So everyone, it's going to be very different, but the most common ones are those quote unquote sin sectors. And then now I would say fossil fuels. And then, the two sectors that, here in Canada, I would say are the most contentious after oil and gas would be the banking sector, because the banks own a lot of fossil fuels and are part of that. And then also the mining sector. And this is a very challenging one because some people are just like mining, thumbs down, I don't want anything. A lot of other people are like, well, you know what? I have a smartphone that has metals and, my computer and my webcam right now. Like I need mining for some part of it. So, so it's just really going to be different for absolutely everyone.
Yeah.
And to me, what I've learned over the years is to stop telling people what they should be doing, what they ought to be doing, and more just like bringing up these issues and asking them. And, really my mission is to help 1 million people invest intentionally. And I don't really care what those intentions are. I don't care if you just want to take a small step in the right direction, or whether, you want to go all the way, to sort of that to me, it's just like make an intentional decision, know what you're buying. That unfortunately, when it comes to investing, too many people, they just bury their head in the sand. They have no idea what they're investing in. And that part of that is they also have no ideas the fees that they're paying, because they end up getting sold, mutual funds by a bank that's kind of ripping them off. And so, for me, it's this really cool power that when people get a little bit of education and understand and wrap their head around this and make intentional decisions, that you're really taking control of your money, both in terms of understanding what you're doing and the fees that you're paying and making sure that you're not getting ripped off. And then also being intentional about the companies that you're investing in and understanding, how far down the spectrum do I want to go? And what am I comfortable? What is the world that I want to retire into?
Right. And just tagging along with like the worst of the worst and like having a very personalized portfolio for investing. How does cryptocurrencies come into this, like setting up a portfolio? Because there's also a lot of information that could be hidden from us investors into cryptocurrencies, right?
Yeah, so crypto is really challenging because of the lack of transparency.
Right.
That because it's not regulated in the same way, and there is a movement to start to bring it into the more regulated areas, and we're starting to see this, that there are funds here in Canada that hold Bitcoin and Ethereum. Those are the two that you can actually buy, these things called ETFs, exchange traded funds, that trade on an exchange. They're a little more regulated, but a lot of the crypto market is, very, very non-transparent. So, as well, it can be really challenging to actually buy and hold these things. I have had some clients who have lost their cryptocurrencies when exchanges have fallen. So in Canada, there was this exchange called Quadriga. And unfortunately, the guy just kind of like left. And I don't know, they say he died while traveling in India, but it's very mysterious. But literally like hundreds of millions of dollars just went missing. So you got to be careful with this stuff. Really, what I would suggest is that, again, diversification is the name of the game. That you don't want to bet all of your money on crypto, and even specifically on one specific cryptocurrency. That instead, if we talk about your pie chart, you might want to carve out, let's say 10 to 15% of your portfolio for cryptocurrencies. From there, do your homework among the different ones. To me, there are some huge environmental challenges around Bitcoin and the amount of energy that it takes. And so to me, that's a bit of a deal breaker for me. I've been spending more time looking at Ethereum. It's really interesting. They're about to go through a big change in a few months, moving from a proof of work concept, which requires a lot of energy and a lot of sort of computational power, where it's just these computers running to do the work. Right. And instead moving to what's called a proof of stake, which is going to drastically reduce the energy efficiency of Ethereum. That said, I would consider, all crypto right now to be very much in this speculative boat. That this is speculation. That for the most part, the sort of the thesis for how to make money with crypto is that someone is going to be willing to pay a higher price for you in the future. Right. And so to me, it's like, it's not necessarily the greatest investment thesis. That it's these coins often don't create dividends, they don't create profits on their own. It's not like investing in a company that has sales and cash flows and earnings. These things are often, really you're betting that it's going to become more popular, that demand is going to rise, and that someone is going to pay you a higher price. So to me, it's like, if you want to do cryptocurrency, totally, I get it. Absolutely your choice. But number one is do your homework, understand what it is that you're buying and the environmental impacts, specifically on the energy consumption side, to me would be the biggest challenge there. And then number two is like, don't bet the farm on this. Like, these things are volatile, and like, it's the strangest thing. that can cause prices to just absolutely plummet. So to me, I would be really cautious with it. And I would carve out part of your portfolio. And then, the bulk of your money, you do want to invest in sort of more standard stocks and bonds, which maybe aren't quite as exciting as cryptocurrencies, but, have a much longer track record, behave in a much more predictable manner, and, are generally speaking, a more reliable way to be able to save long-term for retirement.
Which is something that usually does not sound attractive when talking to a general public trying to invest, right?
Yeah.
Because they want, or people generally want this big gains in as easy way as possible in the shortest time. But you're not the first investing advisor, whom I've heard say, think long term.
Yeah.
And also, the one thing you mentioned, which I think is different from other advisors in investing, is you don't tell them what you do, what you think they should do, but you hear what their interests are and what their values are and how they can align these values, this ethical manner or way of being with their investing portfolio and their investment portfolio.
That's right.
Is wonderful. And yes, definitely the long term, I believe, is an issue when it comes to investing.
Well, I want to address that because to me, it's a difference between investing versus trading. And that over the last few years, with the rise of a lot of these sort of digital trading platforms, where now, like on your phone, on your mobile phone, it's an app, and you can, in the US, they have Robinhood, and there are these kind of apps that people, and that really encourages trading, which straight up, in my mind, is gambling. If you are trying, because if you're day trading, like if you're trading. Right? Like that's when it becomes a little bit of a zero-sum game.
Right.
Where in order for someone to make money, someone else has to lose money. So it's more like playing poker. And to me, it's like, I might think I'm a good poker player, but like if I've just learned the game and I'm going onto these, like there are people that have been doing this for so long, where this is their whole job. This is everything that they do. They know a lot more than I do. I'm not arrogant enough to think that I am a better poker player than a lot of these professional poker players that are now on these websites.
Right.
And so, but that's what a lot of traders think. And that over the last few years, because the market has only gone up and people have made these huge amounts on cryptocurrencies, on things like GameStop, these like Reddit meme stocks, things like that, that, and we tend to get this false sense of confidence that people think it's because of their skill, when really it's because they were lucky. Maybe they got in on it early and the crypto that they happen to buy happened to spike, but that's more about luck than it is about skill.
Right.
And the problem is that a lot of these people have never been through a real crash.
Right.
And that I don't want to like play scary, whatever, but like, these crashes aren't inevitable, right? It's not a question of if, but when. And that, that's when diversification
comes into
and because if you have something like bonds, which bonds are boring, it's like bonds are the most boring thing. You haven't made that much money. It's like the turtle in the race. Like there is nothing sexy about bonds at all. But my goodness, when the stock market crashes, bonds are your best friend.
You'll be happy you have them.
And then that allows us to rebalance our portfolio. And this idea of diversification and rebalancing means that if there is a crash, no problem. I can just rebalance my portfolio. I wait for it to come back up and I can be in it for the long term. Whereas when people put all of their money into very speculative, risky assets, whether it's cryptocurrencies or Tesla, if you only bought shares of Tesla, hey, you made so much money.
Yeah.
But the amount of risk that you're taking right now, if all of your money is in Tesla, one thing like Elon Musk sends one tweet, right? And all of a sudden, boom, everything has crashed. Whereas, by being diversified, by spreading it around, by understanding risk in a more traditional lens, which isn't the sexiest thing.
Right.
But that's how you can really protect yourself
Yes.
That when it comes to investing, not trading, but when it comes to investing, there's this dynamic between what we call capital preservation, which is like preserving your money, right, and low risk, versus growth. And that right now, growth has done so well that everyone, there's a huge sort of momentum swing towards growth, and people are taking on a lot of risk and investing in, innovation and tech and renewable energy and electric cars. And it's like, and, they don't necessarily have kind of peeked behind the curtains to know, well, a lot of these companies actually aren't profitable. And if we were to get into a downturn, which could happen at any point, then I think a lot of people, are going to be unhappy in that situation. So, I really want to draw this distinction between investing, which is long-term, which is having a plan and sticking to it, and it's being diversified and patient, versus trading, which is short-term, which is risky, which is very speculative, and I would argue is more like gambling than it is like investing.
Thank you so much for that differentiation. I think it's important to notice. And one other thing that you also mentioned that I wanted to point out is to, for those interested in investing on cryptocurrencies, or maybe just something risky. I've also heard from other advisors say that invest only the amount you're willing to lose. And you were saying invest only a small part of your portfolio into this cryptocurrencies, if that's what you were like so passionate or interested in investing or having as part of your portfolio, which I think is a good advice. I think it's pretty good. Even though it's different from trading, right?
Yeah. And so again, this is the idea. If you come up with a pie chart, you can be a long-term investor in cryptocurrencies, the diamond hands or whatever, where, people that are going to buy and hold for the long time. But really what you want to do is, it's just so interesting, the psychology, because we all know the old adage, buy low, sell high, right? We agree on that, buy low, sell high. But our psychology, our instincts as humans tell us to do the complete opposite. Because when you hear from your friend who made, a whole bunch of money investing in Dogecoin, right, or whatever it is, it could be anything, but that, and they just tripled their money, your instinct is like, oh man, fear of missing out. Oh my God, I gotta buy Dogecoin. But now you're buying it after it's tripled.
Right.
So you're buying high.
Too late.
And that when things crash, well, we don't know. I don't know. I don't have the crystal ball. It could keep going up, right? But we're definitely not buying it when it's low. And then, when things crash, when we do have a correction, when we do, and this is inevitable, these are the cycles of the market. When it crashes, people get scared and they panic. And what do? They sell.
And they lose.
Whereas what I'm telling you, let's say I allocated 10% of my portfolio to Dogecoin, right? So I invested however much money, and then it triples. Well, if I'm going to stick to my plan, that's when I would say, you know what? Great. I'm going to take my money off the table. I'm going to sell. I'm not going to sell everything. I'm still going to keep it at 10%, but I'm going to take my gains, right? It's like when I'm gambling and I go to the casino and, I bet on, the roulette and my number hits, right? I don't want to put more money on that same number.
Right.
No, I want to take my gains, spread it around. Right. And I can still bet, have my 10% in that space. But the opposite is true, that if it crashes, well, now it's on sale. Now I can get greedy. Right. And now it's low. Now's the time where I can buy. Now, this approach of rebalancing your portfolio and, sort of like taking your profits and then investing more, getting aggressive when things are low. This applies to things that are a little more traditional and that are diversified. That if I'm investing in the whole stock market, or as much of it as I ethically feel comfortable investing in, then I can say with a pretty high degree of confidence that it's not going to go to zero. Right. And if the stock market goes to zero, you know what? It doesn't matter where I've invested my money. That's like the big crash. That's where it's like, I hope I have like seeds and like I'm friendly with my neighbors, you know, like no, nothing's really going to protect me if there's a big crash, if it's like, you know, capitalism fails. But any of these corrections, any of these more temporary things, you know, what we saw in whatever 1929, what we saw in 1981, what we saw in 2008, and what we saw last March, you know, the stock market fell by 33%. Right? But that would have been a wonderful buying opportunity. That's huge. That's so scary. Oh my goodness, a third of my money. Right? Now, if I rebalance my portfolio, I own some boring bonds. Well, those kept their values. In March of last year, I would have sold some of my bonds and bought stocks when they were cheap. And that now I've waited and I've been patient. Wow, they've come back up. And this time they came back up so much faster than they ever have. Right? Like that was very unprecedented. We saw a huge crash and then whoa, bounce back up. And now it's so much higher than it was pre-COVID. And that, you know, and that now, you know, there was this, it's been really easy for me to say, well, look at all this money I made. I should put more into the stock market or more into the crypto market. Whereas for me, you know, my approach is to say, no, like I made my money. I'm now going to I'm going to rebalance my portfolio. I'm now going to buy more of those boring bonds, so that I have the appropriate risk level, that I do have that capital preservation part of my pie chart, so that I'm protected for the next crash. So even though, you know, we know buy low, sell high, our instincts tell us to do the complete opposite, to buy high and then to panic sell when things are low. So to me, this idea of long-term investing is more about coming up with a plan, come up with your pie chart, make an intentional, deliberate decision about how much you want to invest in cryptocurrencies, for example, and then stick to that. And if you do well, if cryptos keep going well, that's great. You've got 10% of your money. You just doubled it. Great. You're awesome. You're ahead of the curve. But if they crash, because we don't really know what's going to happen, no one has the crystal ball and knows the future. If they do crash, it's not the end of the world. You're like, oh, actually, you know, cryptos are cheap now. I can sell some of my other boring stuff and I can actually buy more during the crash. And that it really speaks to this idea of diversification, that the way we build a resilient economy and ecosystem is through diversification. Like that's just a core value. We know that principle works. The way we build a resilient portfolio is through diversification.
The name of the game, like you mentioned it. So I've been mentioning that I've heard from some investors and advisors such and such, but I have to credit and give credit to Tim, because he's the only sustainable investor or advisor that I know personally that I do believe has these values of investing sustainably. And therefore, I know that you advise your clients to invest in a very sustainable way. Now, how do we transition from simply a money concept to sustainable investing? Because, I mean, we've been talking about like these differences of investing just like the traditional way or selecting certain industries or companies. But what goes, from your experience working with clients, what goes in their minds, or what happens is as they are trying to take care of their money in a sustainable way?
It's a really interesting that most people that I deal with start by having a severe lack of confidence around investing. They just don't know that it's scary, and they don't know the language, and they've never learned these things. And going through the educational process, really, it's amazing to see them when it kind of clicks. They're like, oh, I get it now. I understand what he means by diversification. I understand the difference between stocks versus bonds, right? And that it really is, it's kind of that clicking. And what comes with that is so much more confidence. And then the cool piece is that by doing it with sustainability in mind, by bringing in this sort of ethical or this moral, you know, perspective, it just makes it so much more fun and interesting, because this stuff can be really boring. But when you engage people with their values and get them to actually think about it and make these more intentional decisions, they just get so much more excited and interested, right? So to me, it's really like, you know, investing is just, can be really boring. And so, by doing the sustainability piece, it really makes it much more interesting. And I think that goes a long way in terms of building that knowledge, which in turn allows people to become more confident with what they're doing. Now, again, there are different definitions of sustainability. And I'll be honest that it is hard for me, having done that master's program in Sweden and understanding the system level notion of sustainability. I think there's an acknowledgement that a big part of capitalism as a whole is inherently unsustainable. That when I look, especially a lot of the doing less evil funds, there's still a lot of stuff in there that is absolutely, violating the system conditions, and the sustainability principles that we hold so dear. So, I want to be clear, there's no such thing as a perfect portfolio. Right. And especially right now, that it's kind of like we're going to do the best that we can, given the options that are available now.
Right.
And that for people who are a little bit more on like either the hippie side or like the anarchist side, like I have worked with anarchists. I know it's like working with an anarchist on an investment plan. But the idea here is that, well, what if they're wrong? What if society doesn't collapse?
Right.
The worst case scenario for an anarchist is they end up in, government housing because they can't look after themselves and they are now fully dependent on the system they wanted to collapse. So to me, financial independence is actually, it shares some values with the sort of anarchist, this idea of independence and self-sufficiency. But, what they can look at is there is this really cool area. It's still emerging, but it's called impact investing.
Oh,
and this is very much on like the doing more good side, and it's usually on the bond side of the equation. And again, you don't want to put all of your money into this.
Yes.
But this is where we can look at things like community bonds and green bonds and this whole world of social finance. Things like microfinance is such an amazing tool. And this is where, I'll be honest that you are going to be sacrificing some financial returns. Right? That if you're really investing in like community bonds where you're loaning money to nonprofits, to be able to for them to build assets and to have more self-sufficiency on their own, you're probably either taking more risk or getting lower returns than you would otherwise. So this is where, that trade-off is probably, certainly more real. But this is where it's undeniable that you can have a very positive impact in the world with your investment dollars.
And I'm very glad you brought it up because I wanted to mention that as well. Now, would there be profitability in those kind of investments?
Yeah. I mean, you're not going to, get rich off of them.
Yes.
Right. But you are going to earn a financial return in addition to having a positive impact.
Okay. Right? So there is still profitability.
Yeah. Okay. Just not as much as you would.
Not as big a margin as you would have with a different kind of portfolio.
Or so the way we look at it is like risk-adjusted returns, right? And so you're either taking more risk to get the same returns, or you're taking the same amount of risk and you're getting lower returns.
Lower returns, right.
That generally speaking, and this is obviously, it's kind of a broad generalization, but here in Canada, we've got community bonds and green bonds, and these are a lot more sort of like local, a little bit more kind of, I call it like crunchy granola, type of investments where it's like a renewable energy co-op that is building, community-owned solar projects in my hometown.
Yeah.
That's going to be riskier, that, I might still earn like a 4% return on that.
Yes.
But when I compare it to other investments that give me a 4% return in the market, I can probably take less risk and earn that 4% elsewhere.
Right.
But, really what I'm looking at here is that, I'm earning that 4% plus the warm fuzzies.
Right.
Of like feeling good that I'm like supporting a renewable energy co-op in my hometown.
Right. That's so interesting. What has been the most challenging part of good investing?
For me, it was for a long time, it was patience. It was like waiting for people to catch up. That, when I did that master's program in Sweden back in 2007, I graduated in 2008. I came back to Canada, and I think a lot of people thought I was nuts.
Oh,
that I was just talking about, right?
Right. By the way, this is how Tim and I met. we both did the masters on strategic leadership towards sustainability in Sweden, just in different years.
Absolutely. Yes. And I think for a lot of us, like, you get out in front of these things and, living in Sweden, like they sort their garbage into like 7 different bins.
Yes.
And, like, it's just amazing. They're so far ahead of the curve. And then I come back to Canada and it's just like, oh my goodness, like, what is this with the society I'm living in is so inherently unsustainable.
Coming back to Mexico.
and there was so much, my friend and I, we talk, and he talks about this term inherited infrastructure. That now I come back here and there's all this infrastructure around me that is so unsustainable. And that everyone has this idea of a sunk cost fallacy, that we already have all this infrastructure. So I don't want to like tear it up and start over. Like I want, and so it just, to me, the most frustrating thing was for a long time, people just didn't understand what I was saying.
Yeah.
And that at first blush, as soon as I brought up the idea of ethical or responsible or sustainable investing, people automatically assume lower financial returns. Like right away, it was just that, okay, yeah, but I don't want to lose my money. And I'm like, well, actually, you can just as well, maybe a little better. And like, people wouldn't believe me. And I'd show them the charts and I would like prove it. And they'd be like, yeah, but that just doesn't agree with my worldview. So that to me was the hardest thing, was dealing with those power dynamics of, walking into boardrooms and dealing with, frankly, like rich, old white guys that just don't have a very different worldview. They made all their money in oil and gas and mining and banks. And they just think that that's how you make money. And any way else of doing it is just so foolish. And I made all this money. Why don't you want to do this? And it's like, well, I think there's a better way. And so to me, it's been so nice having the world kind of catch up to me a little bit. Very validating for me, to understand.
Catching up with the consequences, I would say, with the reality.
Yeah, absolutely. And that now I would say the biggest frustration in the space is greenwashing.
Yeah.
That, it's just that now, because there aren't regulations around this, it's just it's become a bit of a marketing thing.
Yeah.
And so, seeing people abuse the marketing piece of it. And then as well, what that does is it just erodes trust, such that so many people, their first interaction with sustainable investing is greenwashing. And then they tend to write the whole thing off, where they're just like, Tim, it's all greenwashing. It's all BS. It doesn't, and they just kind of throw their hands up because it's all useless. So to me, it's, that's now the big challenge is, now that there are people that share our worldview, I'll say, and to me, it's kind of, I would say it's this sort of pragmatic optimism. That it's like, yes, the world can be better. The world is getting better, but we need to be a part of it. I can't sit back. I need to actively be contributing to and creating that better world. That a lot of those people are now, have money and have power and want to do this type of investing. But now, it's the lack of education. And the fact that so much of the industry is just so happy to just view it as a marketing exercise where they'll label something as sustainable. But then I open it up and I look what's inside and I'm just like, oh my goodness.
Yeah, they're just looking, going after a certification, a stamp, or some sort of award or recognition, but it's empty. Like you said, you open the door and it's completely void.
So this really kind of speaks to my mission of this idea of intentional investing. This is for a lot of people, this is the biggest financial decision they're going to make in their life is, how they manage their investments, right? And so, give it the time and the thoughtfulness that it deserves and actually look under the hood and look at what's inside and make sure that it actually does align with your values.
Yeah.
But, to me, it's like every challenge is an opportunity. That with the greenwashing, it just shows there's even more need for the work that I'm doing to be able to sort this out and communicate in a way that, helps people wrap their head around it and sort of make those intentional decisions. So, I'm not one to sort of shy away from the challenges. That to me now it's like, because there is so much greenwashing, it just means that, my voice becomes that much more valuable to people. In terms of, helping them understand what is a sort of a legitimate, ESG investment versus, what is a fund that is just simply paying lip service and is absolutely greenwashing.
Great. Well, thank you so much for the work you do. And before we wrap up, I would like to ask you one last question. What do you think is necessary in order to achieve more decisive leadership towards sustainability, like what you were doing, but in general, like globally, regardless of the sector, regardless of your investment portfolio?
It's a big question.
Yes, it is.
To me, it's understanding our biases and working through them. That, I've really come to this term that there is no such thing as an unbiased opinion. People have a bias. And there are a lot of these psychological biases that we have. And you and I talked about one earlier, which is a short-term bias, which I think is a huge challenge when it comes to leadership. That people looking at short-term versus long-term. And this has to do with incentives and people's jobs and bonuses and all that stuff. But we need long-term incentives. I can think of it from a political perspective of a leader that is just working towards the next election versus one that has a longer-term vision and is willing to work towards a longer-term vision. That's definitely, I think, one of the biggest things. And then from there, I think it's just really this, rather than looking in the rear view mirror and looking at past performance and this idea of incremental improvements, doing the work that we do around backcasting, of asking yourself, where do I want to end up in decades from now? And then having a strategy to work towards that. That when it comes to investing in the business world, so much of the data that we get and that informs our decision making is looking in the rearview mirror. It's what's happened in the past. Whereas I think that, to me, what real leadership is imagining the future, regardless of our past, that inherited infrastructure. Where is it that we want to end up? And let's work towards that. And to me, the investment world is such a beautiful way of doing those two things, because number one, it is long-term. As much as people have that short-term bias and want to, win the lottery or want to, find that crypto that's going to triple this year, most investors, especially the big players, the foundations, the pension funds, they're long-term. They look at this through the lens of decades and decades. So they have the luxury. The investment industry can take that long-term view. And then on the other hand, to me, it's really about, people who are committed and passionate about this stuff. It's not, let's not let the past, weigh us down. And this idea of sort of incremental that, I'll be 5% efficiency improvement compared to last year. It's let's really imagine, what is the world that we want to retire into in 30, 40 years from now. And let's start building that world today.
Which is also very much in line with what I believe. I mean, obviously we come from this Swedish sustainability framework background, so we share that platform and kind of like language. But I was giving a conference last week, the International Conference on Sustainable Development of the UN, and my premise was that everybody has to become or needs to become a sustainable entrepreneur. And you are a sustainable entrepreneur, teaching people how to do investment portfolios that are sustainable. And these incremental changes and thinking long-term and creating this future that we all want to be a part of, that you want to be a part of with your investments, with the way you're designing your life. I think it's so important and it's so key for everybody to start like paying attention. And speaking about paying attention, I want to mention that Tim has an online course on sustainable investing. And you can find that on goodinvesting.com. Is that right?
Yeah, that's right. It is geared more towards Canadians.
Oh, that's right.
So I'll be clear about that, my hope was to start in Canada, do a little pilot project. And if I can make it work here, then I would love to be able to build an online course for people in other countries. Unfortunately, when it comes to investing, you know, it is just so different in different regions. Everyone kind of has their own laws and their own rules and tax systems and all that fun stuff. So, you know, for me, it was really about starting here in Canada, in my home, you know, make that change in my backyard, but do it in a way that I hope is scalable, such that in the coming years that, you know, my dream would be to be able to launch a course in different countries.
In Mexico.
Absolutely.
Well, thank you so much, Tim. Don't hang up. Don't disconnect from this virtual studio. I want to chat with you a couple minutes after we end the broadcast. And I want to thank to everybody that connected. We had Sarita from Mexico say hi. It was very interesting to watch us and read us. We had also Omar Roquet from the MSLS group sending us greetings. He said, thank you both for the work you're doing. Go MSLS Power. And yeah, we had people from Mexico connecting, mostly from Mexico. And yeah, just wanted to thank everybody that connected tonight. Muchas gracias por estar aquí. Don't forget to subscribe to my YouTube channel where these broadcasts are going to be broadcasted every time we do a new conversation, a new interview. And yeah, we'll see you in the next one. Thank you so much. Bye-bye.